Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Report on Business. My name's Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. We're thrilled to be here with you today as we discuss the manufacturing PMI data for July. There's a lot to talk about. Production ticked up and there was some prices relief, but factory activity, especially with employment, remained stuck in neutral or even in reverse. The PMI of 48% was a 1 percentage point decrease compared to the previous month. Susan Spence, who is the chair of ISM's Manufacturing Business Survey Committee, had a prior commitment and is unable to join us today. Hey, but we've got a great pinch hitter. Over the years, news organizations have asked him to comment on the PMI data many times, and he's done the media rounds today. And at ISM's annual conference, he's spoken at multiple sessions about how the report on business works. So we're not going to miss a beat. He is Thomas W. Derry. He's ISM CEO. So you can bet I'm going to be on my best behavior here today. Tom, thanks for filling in for Sue. Welcome to the Funhouse. We should note that Tom typically first sees the report on business data when you folks see it after it's released. But this month was an exception, obviously, because he had to prepare for his interviews today. So I'll start off by asking you, Tom, what I usually ask our chairs. What stood out to you most about the numbers?
Yeah, you hit on a couple of them, Dan, but I think that the one that stuck with me and I think is a key takeaway is the widespreadness of contraction in manufacturing in the month of July. So 76% of manufacturing GDP was in contraction in July, and 31% of manufacturing GDP was in strong contraction. And in fact, comparing it to the month of June, 4 of 6 of the largest manufacturing sectors in the United States in June were actually in expansion, but none of those big 6 were in expansion in July. So altogether, that indicates a significant change. Now, it's interesting to me that we did not have the benefit of the announcement of trade deals that came out this week when we were collecting the data. And it's possible more than 70% of the comments received directly pointed to tariffs as a major disruption in supply chains. So that was still the story in July. It will be interesting to note if that changes possibly going forward.
Yeah, obviously that's an issue that is going to be top of mind. That was one of the questions I certainly had for you today. I had a little bit down on my list, but I know it's been talked about all morning, so let's move it up. You mentioned the trade deals that they've been announced recently, and has led some to suggest that maybe the administration's approach is kind of working, and I guess I kind of get that from a political or from a public relations standpoint. But as you mentioned in earlier interviews today, companies still have to deal with the reality of it right now. And I'll note a comment from one of our respondents in apparel, leather, and allied products. He or she said tariff wars are beginning to wear us out. It's been very difficult to forecast what we will pay in duties and calculate cost savings. Right now, there's zero clarity about the future. Maybe that's changing a little bit, as you said, because of the agreements that were announced a little bit this week. But yeah, just talk about that landscape and how companies are continuing to deal with it.
Well, I think it's possible. If the de facto policy, which it appears to be as of today, is reciprocal tariffs of about 15%, right? That's the baseline condition in the deals with Japan, South Korea, and the European Union. Then we as business people just know what the rules of the game are now, and we can adapt to that and move forward. What's interesting, I picked up in the comments this month, was there's quite a lot of discussion about is now the time to begin to try to pass cost increases to our customers, our end customers. We saw it come up in the GM earnings release earlier this week. GM announced that its profits declined by $1.1 billion, about a third of their expected profits, because of tariffs. And GM noted in its earnings release that it hadn't increased its prices to customers yet, but that could be coming. That's a delicate, for a company like GM, that's a delicate needle to thread. It's on the one hand, if I increase prices, am I going to reduce demand for my product? But if I don't increase prices, can I live with this lower level of profitability? And how's Wall Street going to react to that? So it's a tough dilemma for companies. But I think we're reaching a stage where they're going to have to pass along costs to their customers and not have that eat into their own margins. At the same time, I would expect it to be perceived by policymakers as kind of this one-time event. Whereas we had, kind of uncontrolled inflation during the pandemic, which has been improving steadily until very recently. This would, I think, be seen as, okay, one-time 15% increase in price levels for a lot of goods and services. We absorb that, we move on. Eventually, we all get accustomed to the new price point, and it is the price, and we just do it. So in those kinds of conditions, it's possible we could say it's pretty stable, it's pretty predictable, and we can manage to it. And if that turns out to be the case, then I think tariffs become a non-issue by the time we get out of 2025. It's like, we know what we have to do to deal with them. They're here to stay. They're not going away. But we have a strategy in place. We've mitigated them to the extent we can. And it's a one-time event, and we move on. So that's the best case scenario. Mm-hmm. The worst case scenario could be that tariffs remain unpredictable, especially if they're levied for non-trade and non-economic reasons. And we've seen that of late. We've seen tariffs levied for purely political reasons, like in the case of Brazil. That's very disruptive. But those could be one-time events. Maybe we deal with them in the moment. But the worst case scenario is people say, I get the trade deals, but there's still so much uncertainty that I can't really carefully and effectively plan for the future, which is what the respondent said in the comment that you just quoted, Dan.
Mm-hmm. Yeah. Well, yeah, let's relate it to the data for this month, especially, obviously the sub-index that people are going to look at first when they talk about, or want to look at tariff impacts is obviously the prices index. And that reading was a little bit of a pleasant surprise, I guess you could say, 64.8%. Now that's still high, but it was down from 69.7% the previous month. So that's down 4.9 percentage points. Yeah, how big of a nice surprise was to see that slight relief, especially steel and aluminum continue to be the price drivers in that space. And, there have been some tariff turbulence with those commodities as well.
Yeah, and steel and aluminum, I'm glad you mentioned it, because you get hit several times. You pay the 50% tariff on the raw material, then it goes into components that you're also buying, and it gets tariffed again, right? So it's they stack, and it becomes a real problem for people in that way. I think the takeaway on prices is they're still high, right? The diffusion index measures change in prices month over month. So that's still a very high change in prices on a month over month basis. And there is some reason to be concerned about inflation. The PCE number ticked up this week. That's the Fed's preferred measure of inflation, 2.6% on a year-over-year basis. That's higher than the Fed wants, right? Their policy goal is 2.0%. And that has to be concerned. The Fed has got this dual mandate. One part of their mandate is to maximize employment, full employment in the United States. The other half is to maintain control over inflation, the price level. Right now, the employment picture is concerning. The jobs report that came out this morning was very weak, and the two previous months were revised downward, so it compounded that effect. And it has a lot of people on Wall Street speculating that the Fed has no choice but to cut rates in September, which is the next opportunity. And in their minds, the question is it 25 basis points or is it 50 basis points? Now, the reason that's important for manufacturing is a rate cut could stimulate demand, right? And lowers the cost of capital if you need to make capital equipment type of investments. Both of those things could be a strong support for manufacturing, and say starting in the fourth quarter. But it's not a clear-cut call what the Fed's going to do. I think they'll wait for more data to come in, right? They always say they're data-driven in their decision-making. But the case is stronger as of this morning, both because of our report and the non-farms payroll report, that a rate cut could be coming.
Yeah. Well, let's camp there a little. Yeah, because interest rates is a topic that, especially in recent months, has come up in this space and in this broadcast recently. And, we'll clarify that by saying we are not the Fed. We are just interested observers like everyone else. But I thought you had a good comment earlier today in one of the interviews that you did. I mean, Wall Street can have a lot of fun, pricing in their expectations on, what the Fed might do at their next meeting. But, if you're running a manufacturing company or if you're a purchaser, I mean, you can't work based on assumptions. Just take, obviously investors have their outlook on what might happen in September. But, if you're in the manufacturing sector, I mean, you can't deal in maybes, just to expand on that a little bit, because I thought you made a good point earlier this morning.
Well, thank you.
Yeah.
So the financial markets are very sensitive to expectations, right? And they price that in all the time. But yeah, if I'm making a concrete decision about trying to expand my business, I need to see. I only do that with real numbers.
Mm-hmm.
But my local bank cuts the terms of my loan, then I have more confidence in what my future looks like. Can I afford to make that investment now? Can I afford to backfill my open roles in my company, right? And that's something that did come through. As you mentioned, employment ticked down for manufacturing. I think mostly because open roles are going unfilled right now because demand is unpredictable for me. It's not consistent and it's weak. So I'm going to be careful about adding to my team in the moment. But yeah, absolutely true that business people need to respond to real data and hard numbers, unlike Wall Street, which can respond to expectations and where they think the future is going to go. Just two different ways of making decisions, but we need real data in order to make those calls.
Mm-hmm. Well, yeah, we've been talking about the federal jobs report today, and and especially the downward revisions from previous months were ones that caught my eye. But yeah, let's talk about what our index said, because it was certainly in line with what the federal data showed. The employment index came in at 43.4%. That's actually one of the lowest reading in about 5 years, down from 45% in June. Ratio of hiring comments to staff reductions remains in wide favor for the latter, and 25%, that was also an eye-popping number to me, of respondents noted that their companies were reducing headcounts in July. That was up from 17.5%. I've asked Susan Spence in previous months, are things just going to get worse before they get better, and is that what we're continuing to see?
Yeah, I think until a policy outlook becomes clear, we're just gonna hang out where we are, and that's. I mean, another way to interpret this month's data is it got worse. I mean, there's no putting lipstick on that pig. It got worse, but it kind of also went sideways, right? The employment number was very low, and that just tells me that we're just in a place where we don't have confidence that we can gainfully employ people we might want to add to the team, and that the outlook for demand is so unpredictable that I can't say with confidence that I've got work for this person to do when I bring them on board. So employment is something to watch. I'm sure immigration enforcement policies contribute to that to a small extent, although it's not clear from our data how much they might contribute. But people are just being very careful. Even at ISM, we see that in our own numbers, our own business. Companies are being very cautious about what they spend because the future doesn't look clear to them. And I until something changes, until a Fed rate cut materializes, until some factor unlocks more predictable demand for manufacturing, there's no reason to believe that things are going to change dramatically. I don't think the tax bill by itself is going to change the manufacturing outlook very much. Certainly not in a broad-based way, maybe in individual sectors. So there's the only reasons for optimism in this month's report, but there shouldn't be overlooked. The decline in new orders got faster, so to speak, right? And the decline in backlogs also improved. Those are two, and those move hand in hand typically. And new orders and backlogs are what allow manufacturers to confidently predict what their future looks like. So the fact that those began to turn could be a positive indicator. It was also accompanied by the fact that customer inventories were seen as too low. That we brought a bunch of inventory into this country, buying ahead of the imposition of tariffs in the first quarter of this year. And we've kind of worked our way through those inventories at this point. So we have to restock. And our customers have to restock. So if those continue, new orders, backlogs, and inventories continue to improve and build, that could be enough. That would be the indicator that, okay, things are improving in a broad-based way.
Yeah. Just to give you the numbers on those indexes that Tom was talking about, new orders was 47.1% in July. That was up from 46.4% in June. The backlog of orders, 46.8%. That was up from 44.3% the previous month. And customers' inventories which is kind of an interesting index. We've talked about it on previous broadcasts. Sometimes a lower number can be a good sign because that means there are fewer products on shelves and companies have to reorder or customers have to reorder at some point. 45.7%, that was down from 46.7% the previous month. Hey, one index that, I've always kept an eye on, especially during the last 2.5 years as the PMI has generally been in contraction territory, is the production index. And I pointed out to, the chairs, that's really displayed resiliency at times during this time of contraction. It's been higher than you would expect given some of the other dynamics that fit into it. And in July, it actually increased 1.1 points to 51.4%. That I as a layman in my modest education on the PMI and how it works and how factories work, I would think that would be unlikely to hold if new orders and backlogs and inventories, continue to be in contraction. Those indexes, as we just pointed out, have gone up, but they're still in contraction. Yeah, just talk about the production, dynamic. And I know it's a positive, but how does it fit in big picture given some of those other indexes?
Yeah, I think it's not sustainable over time. You can surge production on a temporary basis. You can add a shift, you can sweat the assets, as they say, work them a little harder. But at some point, to sustain that higher level of production, you're going to need to add a line. You need to hire some more people, right? So what it suggests to me is that we're working our teams harder right now, right? But that isn't a long-term sustainable situation. So if the other indexes that we mentioned just in the previous question continue to improve, then I think the conditions for maintaining higher levels of production are being fulfilled. But if they continue to be weak or even trend down next month, that's why the reaction to the trade deals is going to be very important to pay attention to. If they continue to improve, then I think then we're beginning to see a groundswell of turning around the macro environment in general for manufacturing. One thing that we haven't touched on, the big 6 manufacturing sectors in the U.S. economy includes computer electronics and chemicals and transportation equipment, among others. They all contracted. In June, 4 of those 6 were expanding. So that's a worrisome sign. It's moving in the wrong direction. So there are definitely these cross currents in this month's report. Some reasons to think, okay, maybe we've hit a trough. Maybe there's some signs that things could improve in the future, but also some signs like this is right now not moving in the right direction. So it could be we're in the trough, right? And we have to stay in the trough for a little while and then climb back out. Or we could be beginning to see the signs of, these are the conditions, if they continue in this way, would lead to the composite index getting back above 50 at some point in the next few months. But right now, it's really not possible to know.
Yeah. Another fun index that, is fun to keep track of, especially when you watch the way it works, is supplier deliveries. We occasionally mention for the uneducated that is the only index in the report on business that is inversed. So a reading below 50 indicates faster deliveries, and a reading above 50 indicates slower deliveries, which is typical as demand raises and the economy improves. Given conditions, I don't think it would have been a surprise that it went down a few points, but I didn't expect it to go down as much as it did. 4.9% down from 54.2 in June. It actually went into contraction or quote unquote faster territory, 49.3. Some of the demand issues, obviously maybe some port congestion issues have eased. Just talk about some of the factors that might have, went into that reading that was a mild surprise. I mean, at least to me.
Yeah. Well, yeah. And so you're right that generally speaking, faster deliveries are correlated with a weaker economy. And generally what's happening then is suppliers are pushing product to their customers, trying to maintain their own level of sales, right? And what we saw, I think, is twofold. I think some of that was happening, and that's consistent with the weaker conditions that we talked about, 76% of manufacturing GDP being in contraction last month. That's all consistent. But I think another contributing factor is some of the congestion we've been experiencing in supply chains is beginning to unclog. And there are a couple of factors. You talked about the ports, that's for sure. But something as simple as your customs broker being able to accurately calculate the duties you owe. The tariffs were changing on a daily basis in some cases. And so the calculation was changing on a daily basis. And to which components and in what levels does it apply changed, So they needed clarity around all of that. And so stuff was getting stuck because we couldn't calculate duties and pay them. That's becoming a little clearer, and so things are moving along faster. So that element of congestions that led to artificially longer lead times, arguably, is clearing up and helping things return to a little bit more balance. I mean, it's still right around 50. It sort of suggests that lead times are about where they need to be for people to maintain stable levels of production, maintain stable levels of inventory. It's the movements, it's the strong movements in either direction that you really have to pay attention to, because that indicates something significant is happening in the supply chain.
Yeah. While we're talking about tariffs and shipments coming in, one question that I did have for you, it's not necessarily related to this month's data, but maybe something that you've heard in your recent conversations with people in the supply chain community, the de minimis exemption, elimination of that. I don't expect Ford and GM are getting too many shipments, that are less than $800. But, so it won't have that, a big impact for those kind of manufacturers and companies. But, there are a lot of smaller companies that, have, taken advantage of that exception over the years. I'll be really interested in the comments next month to see it, if that is a factor. But I mean, what are you hearing? I mean, do you expect that to be a big factor among the manufacturing community?
Yes, but in this way, I think, first of all, think about some of the things that came in under those de minimis exceptions when they did exist. It was consumer goods like cosmetics and that kind of stuff. It was textile and apparels, right? This relatively small order items, often very consumer oriented. We're not going to have to pay more. Right, for those, they're not going to be as cheap as we were accustomed to them. That's going to affect how consumers respond. It's going to affect demand for those goods. We'll probably buy less frequently or buy in smaller quantities as a result of that. Maybe because we're forced to, right? Because maybe just in order to maintain their affordability for us, that's going to have a big impact. It was also a loophole in terms of shipments going through places like Mexico. So Mexico, the USMCA agreement in place with Mexico and Canada, stuff was moved to Mexico, came through Mexico, minimally transformed in Mexico, and then came in, tariff-free into the United States. Even the Sheinbaum administration in Mexico recognized that this was a problem and started to crack down on it. So, for instance, furniture was coming through Mexico, and then therefore getting in the United States market on a tariff-free basis, coming through Vietnam, for instance, into Mexico instead of directly from China. So that's the other way in which people are trying to crack down on these loopholes that did previously exist. They're loopholes if you think about it from the administration's point of view. From another point of view, they're just, hey, that's the preferred trade policy. Is we want to impose fewer trade restrictions and lower or non-existent tariffs if we can. But the ability to avoid tariffs is being clamped down on, and that's going to affect the consumer.
Yeah. Well, one of the questions that I regularly ask our chairs, in these broadcasts is, if I'm a CEO, what do I, need to know about this month's data? Well, I'm especially blessed this month because I got one. But not only are you one, but I mean, you talk to other CEOs, which is really why I'm glad that you're here this month. I mean, you're in a unique position, because you talk not only to manufacturing executives, but policymakers, other stakeholders. I mean, what are some of the most frequent themes that you're hearing about the state of the manufacturing sector and, how that relates to the overall economy?
Well, price increases are coming. The ability to withhold, imposing those passing those price increases along to your customer, companies are running out of patience with that. And they can't afford. I mean, another good example recently was Apple. Apple reported a 13% surge in iPhone sales because people were buying ahead of imposition of tariffs on the new iPhone handsets. They also had moved a lot of their production capacity from China to new Foxconn facilities in India. Well, the president announced just this morning a potential 25% reciprocal tariff on India. So India no longer becomes a place where Apple can manufacture its iPhone handsets with relatively low tariffs, right? So now what's their sourcing strategy going to be? So it's the price increases are coming because companies are going to have to impose. And Apple did not increase the price of its handsets because of tariffs, and they took an almost $800 million hit because of tariffs in their most recent earnings announcement. So price increases are coming. Tariffs are here to stay is the other thing. Now, when I talked to people at our June conference in Orlando, one of the interesting takeaways I developed from all those conversations with hundreds of people was that people are actively in the process of figuring out what their mitigation strategies were going to be, right? And many companies express confidence that we're nearly there. You know, we've made changes in our sourcing strategy. We re-engineered our products so that the components are exempt. We've been able to pass along costs, or we've been able to negotiate price reductions from our suppliers that offset the tariffs. And I realized that most companies will have their game plan ready for tariffs, by the time we get to the end of 2025. So if it is this sort of more stable environment of largely 15% tariffs across the board, we'll have figured out our strategies and they'll be in place. It won't be a problem for business. Consumers will react. They won't like the price increases. The economy may have to adjust a little bit. There could be some reduction in overall demand due to higher prices. But from a supply chain perspective, tariffs will no longer be the major disruption that they are today. And I think that's a little counterintuitive for many people, but we'll have solved for that problem. It'll be something else. It'll be another Suez Canal. It'll be a major weather event or perhaps a geopolitical event that we need to solve for. But tariffs will be baked in, and they'll just be a fact of life.
Yeah. Well, hey, Tom, this has been great. I really appreciate it. Just anything else that I haven't asked or that we haven't talked about so far that you think might be, important to add as we wrap up the month?
Well, I definitely am looking forward to the Fed decision in September. I think if they cut rates, that's good for manufacturing, and it could be the stimulus the economy needs to. Now, remember, GDP was a good number for the second quarter. It came in at 3.0. So that tells me the services side of the economy is likely is holding us up right now. So it doesn't mean that a recession is on the horizon or anything like that. But I'll be very interested in the rate cut decision by the Fed in September.
Yeah. Well, yeah. Thanks a lot, Tom. This has been great. Yeah. Stop by anytime. We had a great conversation. Hey,
okay.
Thanks for joining us today. And for more information, feel free to go to ismworld.org, where you can read our roundup article that details a lot of what Tom and I have discussed here. And if you want to be a part of the ISM manufacturing, services, or hospital business survey panels that help compile data for the report on business, then visit ismworld.org/join the panel for more information. And join us on Tuesday when we break down the Services PMI with Steve Miller. He's the chair of ISM Services Business Survey Committee. So for Tom Derry and the people who helped us behind the scenes, they're Christina Cahill and Jennifer Stevens. I'm Dan Zeiger, and we'll see you on Tuesday. Take care.